Right. Okay. So, as you can see, the conversation we're going to have this morning is about the macroeconomic environment of Corona, not Corona itself. So I don't want to get into the micro details of, how long it's going to last and, what sectors are affected. We'll do that because obviously we cannot have a conversation like this without at least in passing dealing with that, but it's not the focus. So this is not a micro conversation, it's a macro conversation. And in terms of what I want to do, I want to start, apologize, I'm just looking at the Q's and A's. Question from Angela. Yes, Angela, we can certainly do that. I want to start off with just some historical perspective because, you read in the press, oh, it's going to be the worst recession since the financial crisis. It's going to be the worst recession since the Second World War. It's going to be the worst recession since the Great Depression. It's going to be the worst recession since Moses. No, that's my own one. So let's just get some historical perspective. How bad have things been in the past to get an idea of the magnitude of what this could be like. I then want to spend time on just looking at things before the Corona pandemic started. So what was the macroeconomic environment? Because if we're going to assess the macro environment and the implications of the impact of Corona, so I'm getting a lot of stuff coming through in the Q&A. Okay, I think, Jasper, I'm merely going to ignore your question. Sorry, with apologies to the rest of the audience. One of the things I love about MBA graduates is they're really bad jokes. And if you look at the Q&A, you'll see some really bad jokes coming through. So we need to understand the macro environment that the world was in before Corona hit. Then I want to understand the immediate impact, okay, which is the sort of micro stuff that we see a lot of. Then I want to understand the wider implications. What's the big picture, not the small picture, not how many people are sick and how many masks do we need, not what's going to happen to tourism, but the bigger picture. And then finally, I want to have a look at policy options that would address the Corona, the implications, and then we're going to wrap up with the really, really important one. What's the political imperative of what's going to happen? Okay, so let's start. In terms of just long term, let's just get a sense of what have things looked like historically. Well, this is the United Kingdom business cycle, United Kingdom economic impacts. And just if I can, this is the financial crisis over here. We'll come back to that, but I think just to get a sense of perspective. So the financial crisis, about a GDP fall of about 4%. But the one that I want to pick up on as a starting point is this one here, which is a really big one. And you can see where the US economy shrinks by about 8%, 9%, and then 10%, just short of 10% in both those years. And that is the aftermath of both the First World War, the so-called Great War, and the Spanish flu. And clearly, as you know, and if you don't, welcome to it, as you know, this current pandemic is the worst pandemic since the Spanish flu. And the Spanish flu, the death rates were somewhere estimated between 20 million and 100 million people died with the Spanish flu. Now, there's no way to separate out the impact of the First World War and the Spanish flu on the British economy. You just can't do it because they were together. But be that as it may, if one just gets a sense of, okay, so in terms of historical perspective, how big was that? That's how big it was. It was about a 10% drop in GDP. So just to get a sense of a yardstick of what is the Corona pandemic and its immediate impact possibly going to look like compared to what's happened historically. The second one then is to look at the US. Now in the US, there's your financial crisis. And the reason I keep pointing out the financial crisis is because that for all of us in this room is living memory. We can all remember what that was like. We can all remember how poor we got in the financial crisis. If you look at the UK, we have a contraction in the UK of about 4%. In the US, it's a much smaller contraction. It's about a 2.5% contraction. But this particular one, what we want to focus on, it's the one that everybody has been talking about, and that's the Great Depression. And you can see the Great Depression. So here we're looking at a 4-year depression, where it's a significant length of depression. And you're looking at GDP drops from 8%, 6%, you know, real humdinger of here of 12%, and then a much smaller one. And of course, in case you don't know, what saves the US from the Great Depression is in fact the Second World War, which is that one there. Otherwise, the depression probably would have gone on a lot longer. So again, with some historical perspective. Now, where I want to take the conversation is not just how big were these financial crises, so not just how big was the Great Depression, which we've done, or how big was the most recent financial crisis 10 years ago, but also what caused them, because that's what we need to understand about Corona and the environment in which Corona is operating. So in terms of the Great Depression, the causes were an equity or a stock or a share, however, whatever words you want to use, they all mean the same thing. An equity and a housing bubble, which collapsed. So we have stock markets that collapsed. We have housing markets that collapsed. That was the trigger for the Great Depression, which then, and a lot of the fuel that lay behind the Great Depression was in fact fueled through bank credit. So we had significant bank credit feeding into these bubbles. If you're not familiar with the term, just a quick Q&A if we're not familiar with the term on bubbles. Okay, if we're not, I apologize, I'm just reading a question which looks, Vivek, can I come back to your question? I'm getting a lot of, okay, so again, please, a housekeeping rule. I'm getting a lot of questions of substance in the Q&A. Please, at the moment, let's just keep it to questions of clarification, then we have time for substance. Otherwise, we're not going to finish. It's the borrowing against equity and property, and the collateral that was used as equity and property, when that's what drove the bubble. A bubble is where you have a price earnings ratio which is completely skewed out of reality, so that the dividend flow or the rental flow from properties are just do not justify the actual capital value of the asset. So when the bubble bursts, the banks collapse. This is, in the case of the Great Depression, then there was a natural event. Please, in this case, it's not here, not pandemic, but please read pandemic. I hope at the early stage of this conversation, you're already starting to put some pieces together. Okay, because if you think about Corona currently, so what's happening? Well, Corona obviously is the natural event. What's going alongside that? Just let's watch that space. Then in the Great Depression was bad policy, and the bad policy was bad monetary policy in that interest rates were increased, bad fiscal policy in the sense that government expenditure contracted and taxes went up. Come back to that one. And then bad trade policy in the sense that there was a trade war where America, the US, imposed a trade war on France, Italy, the Netherlands, and Germany. Okay, please draw your own conclusions about the lessons we learned from the Great Depression about the situation that we're in today. Now we come to the next of the big financial crises, which is Japan. And for those of you who don't know, the Japanese economy is in a very sorry state and has been in a very sorry state for a long time. And if you look at the Japanese economy in this diagram, you'll see a whole series of recessions that happened over Japan. And the Japanese refer to this as the lost decade. And now a decade is 10 years. And I know the Japanese are very clever people, but clearly they can't count because a decade is that that over there. So, but it's a nice label rather than decades. So if you look at the recessions in Japan, you can see there's the first recession, there's the second recession, there's a third recession, there's a fourth recession, and that's today. Now, that one there is the last quarter of 2017, and we're looking here, please take note, minus 6.3% in Japan in the last quarter of 2019, minus 6.3%. So Japan is a classic case that if you want to get it really, really, really wrong, do what the Japanese did. So the Japanese, the start of the last decade is an equity or stock market and housing bubble, which is funded by bank loans. So when the bubble bursts, the banks go bankrupt and people don't save into the banks. So we have sterilized savings. Then to compound it, what Japan has is deflation. And that's a major problem in Japan. Please, again, this is not a history lesson. It's to try and pick out the pieces of some historical incidents which could come through again. And in Europe, as we speak, deflation is a major threat. The fact that people are not spending is a major threat. And then in the Japanese case, we don't have, well, we do have bad policy, but the problem with Japan is we have policy which is too little too late. So Japan implements monetary policy by reducing interest rates, and predominantly reducing interest rates, and then later on the introduction of quantitative easing. Apologies, I see lots of questions coming through. Okay, there's an anonymous, apology. Here's a question, if I may, a question of clarification. We have an anonymous attendee, so Mr. Anonymous, or Miss Anonymous, as the case may be. It's, okay, so for when we talk about bubbles, either an equity bubble or a housing bubble, the consequence of the bubble is a major loss in wealth. So your share portfolio has gone up, your housing, your real estate's worth so much more. And when that bubble bursts, you are just poorer, so much poorer. Not just in a practical financial sense, but psychologically poorer. You really feel poorer. And the consequence of feeling poorer is people spend less. So this kind of impact has a dual impact. One, your income falls because business is lower and all the rest of it. So you spend less. But the second is you spend less also because you're poorer. And the reduction in spending then impacts on other people, and everybody as a result has lower incomes. Okay. There's a question, Tom, to you, just from Mr. Anonymous. Are the questions to the answers live? I think they are, because this whole thing is recorded. Okay, so yeah, okay, so yeah, I'm just looking. We've got a little private administrative chat box here as well. That, yeah, so it is recorded. Okay, Kun, welcome, Kun. Nice to see you again. I don't know what you mean by that, but we'll continue. Okay, good. I'm not going to answer the question now. Can we leave that question over? Because that's a question of substance, not a question of clarification. So if you don't mind, I'll come back to that. So in terms of monetary policy impotence, what you've got in Japan is, because banks collapsed and people lost their, and we have what is called sterilized savings, where people are saving under the mattress. In Japan, you also have deflation, which means that prices are falling. So because, if you just visualize it, if you've got money under your mattress and prices are falling, then the real return to the money is positive. So Japan can drop interest rates to zero, but real interest rates are positive, which means that if you have a loan with the bank in Japan, the interest rate may well be zero, but the real cost of borrowing is 2% if deflation is 2%, which means that when you get to interest rates of zero, it becomes very, very difficult to drop them less than zero. Now, I know that the ECB has attempted to do this and is attempting to do it. I think the best lesson of the dangers of negative interest rates is Sweden. And in Sweden, the banks and particularly the life assurance companies are, it's an existential crisis for them. So the next thing one has in Japan is fiscal policy impotence. Because government debt is so high in Japan, and the Japanese realize that given the high levels of debt, the Japanese government have to increase taxes in the future. They have to increase taxes. And that's precisely what happened here. So this huge drop in the Japanese economy in the last quarter of last year was because taxes have to go up because government debt is so high. So therefore, if government wants to stimulate the Japanese economy by reducing taxes, all that happens is that people save the reduction. We have fiscal policy impotence. Then we come to some other business cycles. So the first one is the so-called dot-com bubble, which is the NASDAQ meltdown, and then the financial crisis. This, of course, is the US and UK, as you can see. The next one that we have is France and Germany. There's your so-called dot-com bubble and financial crisis. And in the case of Germany, a more recent embryonic recession. Then if we look at, excuse me, Italy and the Netherlands, there's the dot-com bubble, there's the financial crisis, and then the Italians, because Italians always do things with style, with all due respect, there's another Italian recession here and another Italian recession over here. I'd like to pause at this point. One of the things that worries me in the European context is Italy. Italy is the third biggest economy in Europe. It's the third biggest banking sector in Europe. And there are some serious political fault lines in Italy, which have implications for what could happen in the Eurozone. The second one is Spain. I'm not showing Spain in here, but let's flag it for a little bit later on if we have the time. So in terms then of, apologies, in terms then of the dot-com bubble, so this is the dot-com bubble that you're seeing over here, which as you can see is really minor in the scheme of things. It was, you know, a very small thing that happened. What the American president at the time was George W. Bush, and George W. Bush looked at what had happened in Japan and looked at the development of the last decade in Japan and decided, and I think rightly so, that whatever America did, they must not do what Japan did. So where Japan did too little too late, the Americans did the exact opposite. So the cause of the dot-com bubble was a major equity bubble or a share market bubble, which then collapses. So we then have these major negative wealth effects. My apologies, I'm just looking through, I'm seeing a lot of, apologies, I'm seeing a lot of questions come through. Can I just monitor that I'm okay, VP, I'm going to hold those kind of questions because these are questions of substance that you're asking. Can I, Tom, a question to you. Can everybody see the question answer box? I think we did say they could, right? Yeah, okay. So just if you know, you can look at the question answer box, but most of these questions, please, VP, I'm going to hold them over if you can come back to me in that question. So in the dot-com bubble, we have a major equity bubble. Then we have bad policy. We have higher interest rates. Okay, and then we come to the big one. We have policy which is too much for too long, because if you go back, look at the dot-com bubble, it's really, really small in the scheme of things. Yet the policy responses are massive, and justifiably so, because what America did not want to end up in is the situation that Japan found itself in. So we have now the exact opposite of Japan, too little too late. In America, too much for too long. Now we have, okay, yeah, okay. For the moment, I just see a lot of stimulus. I'm going to ignore those question and answers at the moment. We have massive monetary stimulation. I mean, the kind of, and I'll show them the data in a moment, the kind of stimulation that we're seeing was just extraordinary in terms of negative interest rates across a long period of time, and massive fiscal stimulation. And you may remember that the fiscal stimulation in this case here was twofold. You know, what did George W. Bush do? Well, he cut taxes and he increased expenditure. And those were really, really good things to do. Unfortunately, he cut taxes for the rich and he went to war. So the details about this is a little bit problematic. So what you have is really what is a minor economic slowdown. It's not a major recession. We have massive monetary stimulus. We have massive fiscal stimulus. And that was money. It wasn't real things. It was money. There was massive printing of money. A lot of the government expenditure was funded by borrowing, which was funded by money. And that money had to go somewhere. It had to go somewhere. Money doesn't just sit around doing nothing. It has to go somewhere. And that's where it went. I'm pausing on purpose. I think many of you will know this. For those who don't, let's just get on the same page on this one. The financial crisis and the excesses of the financial crisis were predominantly caused by the policy responses in the States to the dot-com bubble. And that massive increase in money, that massive increase in debt had to go somewhere. And it went to the next round of equity and housing bubbles, which once that money started, once that excess money found its way into stocks and into housing, people were able to take their assets as collateral to go to the banks, to leverage their assets, to borrow more money to fund more property purchases, more stock purchases. And when the bubbles burst, it resulted in massive bank failures. Now, this one, we all know about it. We all know about Lehman Brothers. We all know about Bernstein. We all know what happened. Royal Bank of Scotland, my personal favorite, Santander, ABN AMRO, all of those banks went bankrupt. So not just an American thing, as you know, but a worldwide banking failure as a result of the way that the debt had been structured, and the whole thing starts from an massive increase in money. In the Europe, as you know, there's a major sovereign debt crisis, which is still ongoing. Okay, so let's not fool ourselves that we're talking about something that happened 10 years ago and it's history. It's not history. The sovereign debt in Italy, in Spain, in Portugal, in Greece, in France, those countries still have excessive sovereign debt. Just if you don't know the word sovereign debt, government debt. Government. And then just to compound this all, so what happens after the financial crisis? Well, we have policy, too much for too long. I'll show you in a moment, but the policy in the US lasted until about 2016, the policy stimulation. The policy stimulation in Europe lasted to about 2019. I'm just seeing, apologize, questions coming through. No, from Mr. Anonymous, I agree absolutely. ABN AMRO did partially survive and didn't collapse. So I'm not talking about collapsing, I'm talking about bankruptcy, but with one exception, only Lehman Brothers actually collapsed. They all went bankrupt. Mr. Anonymous, I see a certain amount of sensitivity in that one there. If I may, I'm very cross with ABN AMRO because, in fact, if you don't know, I'm actually giving you this talk from Cape Town. And I've, for a long time, for 15 years, had an ABN AMRO account, which they closed down because they had to save costs. So all non-European accounts were closed down, but that's just my own personal crossness. That's why, Mr. Anonymous, that's why I chose ABN AMRO as for the content. Okay, so policy, too much for too long. Monetary policy, there has been massive money supply increases, which I'm going to show you shortly. There has been massive fiscal policy increases, which I'm going to show you shortly. And the problem is, all of that leads to a situation where there is very little room to maneuver in the next crisis. And I actually should have changed that word, next, to this. So if I can summarize before I've opened the next slide, do I do that? No. If I can summarize the way this is built up, it builds up from Japan, too little too late, from the dot-com bubble, too much. That feeds into the financial crisis. The financial crisis, we have to save the world economy. And that leads to massive money supply increases, massive increases in government debt, and very little room to maneuver. Okay, I wonder. I think we're about to change subject now. So maybe I should do something very briefly, and maybe we take a few questions, 2, 3, just for a few minutes, on what has been said. So I'm going to look at the Q. Can we do this on a Q&A, in the Q&A box? Okay, so there's 2 questions from Gimli. We've got a funny name. Do I mean austerity? Yes, but only partially austerity. It's much more than austerity. And when I talk about policy, do I mean austerity? No, I mean much more than austerity. I mean also in terms of fiscal stimulation, in terms of monetary stimulation. So it's policy in the broadest macroeconomic policy. Peter, I'm going to pass on your question to give a view on the relationship between crisis and government support regulations. It's an institutional question, so if you don't mind, I'm going to pass on that. Yeah, I think from Fischel, can I, for those of you who are looking in the Q&A box, I think the question from Fischel, there doesn't appear to be an alternative to getting out of the crisis other than spending and that big government spending. The answer is yes. Yes, that is correct. But then we have to look at the consequences of that action. From Hans. Hans, your question is very, very similar to Michelle's question. So yes, it's the same kind of question. So the questions that are being asked here are all where this talk is leading to. From Hadi, can I take Hadi's question as the last? Okay, there's one more. Okay, I look at Joseph. Can we stop at that point? Let me take Hadi's question. Hadi, the question that Hadi's asking, if you wouldn't mind reading it. You may have noticed in the last little week or so how the Americans, with support from some other players, but largely Americans, have been blaming China for the development and distribution of the coronavirus. And Donald Trump, quote unquote, said last week that this is an act of terrorism that puts 9/11, where 9/11 pales into insignificance from this act of terrorism. Hadi, I think that's your answer. Okay, I think can we hold off now on the questions? I'll take 2 minutes. I've got a question from Joseph. And then from Eric. Eric, I'm going to answer, Eric, your question straight away. There is no alternative. Okay, we can deal with it later on. And then Joseph, do we need to consider unseen deaths such as baby boomer retirements? Joseph, your question is a really important and a significant question. It's not something I'm addressing at all this morning. We could maybe do it in a different discussion. It's not a macroeconomic, in the sense of short-term macroeconomic issue. It's a much more a medium-term macroeconomic issue. So it's not, in my view, right now critically important, obviously, but for people retiring, it is. Oh dear. So with apologies, for people who are retiring right now, don't. Okay, I'm going to, there's a million questions. I'm going to pass on, please. Otherwise, we're not going to finish here this morning. So we'll come back to these questions in due course. Okay. So now let's move on. Let's have a look at the position that occurred before the coronavirus happened. I want to look at economic growth. Then I want to have a look at some economic indicators on the outlook before the pandemic. I want to look at what was debt like, what was bank solvency like, and what were stock markets like. Okay, and if you look at the list, okay, I see a lot of questions. Can we hold the questions now, please? I'm not going to answer them. So let's just hold all the questions off, and we'll get back to that in due course. So if you look at the list now, you'll see that the list is stacked very much like the factors that have caused all the other financial crises. So that's what I want to start looking at. What was the world like? What was debt like? What were stock markets like? In fact, I should have housing there as well. What was bank solvency like? Because if we're going to take the lessons, the historical lessons of other financial crises, we need to understand what's happening today in the context of those other crises. So let's learn the lessons of the past. So this is economic growth. And as you can see, you've got China, you've got the US in this one here. And if you look at China, first of all, take note of this decline in growth, this long decline in growth over here, and the trend. Now, clearly, the kind of numbers we're looking at here are, extraordinarily high. I'm not entirely sure that I fully believe those numbers, but whether it is 6.2% or 5.5%, the Chinese growth sits in that kind of ballpark. But the trend is important. If you look at what's happening in the US, again, you'll see a trend. Again, it's a positive. I mean, the number is 2%. So that's a good number, particularly from a European perspective. It's a good number. but the trend is a downward trend. If we look at Germany, now the red mark in the diagram here, that's 0. And look at the trend. So there was pretty strong evidence, and I'll show in a moment, that the German economy was heading for recession as per the end of last year, irrespective of Corona. And I don't know what happened there. Okay. Sorry, I'm having a strange thing with my animation. And then the French economy also, if you look at this very, very low growth rate here in the last quarter of last year, and the trend, it's not as obvious a trend, but if you take it from 2018, look at the trend in France, look at the trend in Germany. Okay? Both of these were trending downwards fairly dramatically. If we then look at Japan, poor Japan, I mean, you know, you have to weep for Japan. There's 0, there's the Japanese economy. If you look at the UK, now the UK is pretty obvious, okay? How do you spell Brexit? And then later on, how do you spell Boris? Okay, so that's what's going on over here. And then if you look at Russia and Brazil, in the case of Russia, there's 0, marked in both cases. In the case of Russia, we have a recession 2016, 2017. Brazil has the same kind of thing. That's an emerging market issue, which is a consequence of QE in Europe and the US. But who cares about emerging markets? I mean, I live in Cape Town. So, and again, if you look at Russia, you know, fairly low levels of growth, but a lot better. And in Brazil, also fairly levels of growth. I'm not going to show South Africa because it's the most terrible and depressing sight. So now what's the outlook? Because it's not just what was happening, but you know, what do the indicators show about the outlook? And the first indicator I want to bring into you is the Baltic Dry Index. If you're not familiar with the Baltic Dry, then just let's understand what it means. The Baltic Dry Index is the cost of moving freight in vessels on the ocean. So soybeans, aluminum or aluminium, however one wants to say that, coal, cheese, because this is a lot of the audience is Dutch here, with apologies. Soybeans, things of that nature. So when the world economy grows and there's an increased demand for trade, then there's an increased demand for shipping and the movement in shipping. So the cost of shipping goes up and Baltic Dry Index goes up. And when the world economy slows and there's less demand for coal, there's less demand for iron ore, so there's less demand for shipping, there's less demand for space in ships, and the cost of moving it declines, and therefore the Baltic Dry Index goes down, so the cost of shipping goes down. So Baltic Dry is a very good indicator of what's happening with world trade. If you look at Baltic Dry, this is September of last year, 2019, and just look at the trend in Baltic Dry. Okay, so there's a long drop in the index, and take note of the magnitude of the index, from 2,500 to 750 or even 500 in this particular case. Now, just so that we don't get a sense that it was actually Corona that caused this, there's the very first case of Corona being reported in Wuhan. It only begins to impact on world trade probably in about January, early February. You know, so this is nothing to do with that. And this thing over here is a dead cat bounce. So it's, again, I don't have any, I don't really hold with that being as a recovery. So if you look here, then you can see that there's this long decline in Baltic Dry, which just says world trade was slowing. If you're not sure what a dead cat bounce is, I don't know if I've got time to do it. This is not my term. A dead cat bounce, if you take a dead cat and you climb to the top of a very tall building and you throw the dead cat over the top of the building, the dead cat will hit the ground and bounce. It's still a dead cat. That's a dead cat bounce. So the next of the indicators that we want to look at is the Purchasing Managers Index, or the PMI. And again, most of you in the room will know what this means, but just in case there's one or two people who don't, in every large company, there's somebody called a purchasing manager, and they purchase intermediate products in anticipation of the production of their final product. BMW will purchase exhausts if they expect to sell more BMWs. So PMI index is a leading indicator of expected output. There are two types of PMIs. There's manufacturing PMI, BMWs, okay, and there's a services PMI. Frankly, I don't give the services PMI that much. I don't take it that seriously, because we talk services would be, for example, hotels. So if you're a hotel and you expect more tourists, then what do? You order more towels and you order more soap. Okay, so you know it's not a big deal. So here is the US PMI, and the first one is the manufacturing PMI. You'll notice this long drop in the PMI with a bit of recovery, and then there's a tail. I can't really comment on the tail, but I look at the trend, and it's definitely a downward trend. And I look at the services PMI, which kind of fits the same sort of trend. So in all honesty, you know, what is PMI saying about the US economy? It says that it was slowing. There's no question about it. There was potentially some recovery, but I don't know what that's saying just yet without the rest of the data. And the same is true for the services PMI. If I look at Europe, in Europe, your 50 is your neutrality index. So if you're above 50, you're positive. If you are below 50, you're negative. I need not say more, but I will. But I think, given apart from the fact that we've got that in Europe the PMI is below 50, look at the trend. And then if we look at the services one, okay, there's your 50. If you look at the trend, you can see again there's a long-term trend along the downward trend. If one comes to the UK, there's your 50s. Look at the downward trend. Okay, so how do you spell Brexit? And interestingly enough, how do you spell Boris? How do you spell the reconciliation, the certainty that we saw in the last quarter of 2019? Well, I suspect that that's what you're seeing in terms of certainty, and again on the services index here. So there's a little bit of recovery shown in the UK. India, it's a strange one, okay, with definitely something happening here. Because we don't know what this means over here as of yet, or as it would have been. I mean, we'd never be able to call it what that meant, because obviously Corona hits as that data is finalized. As many of you, of the 400 people in this room, I see one person left and gave up. Of the 400 people in this room, many of you are in the Netherlands. There's neutrality. There's the trend. This is not a pretty sight. Please don't take comfort from that. Then the next of the variables we have to look at the indicators is confidence, both business and consumer confidence, because that's what determines investment, that's what determines spending. So from the question was asked earlier on about wealth effects from the anonymous person in the room. When you feel richer, you spend more because your confidence is up. When you feel poorer because you may have lost your house worth less, or your stock portfolio is worth less, then consumer confidence is down, you spend less. So that's the relationship. So now again, the arrow points at the point of neutrality, they aren't always 50. This is the US. Look at this. And that's business confidence, as you can see. And then if you look at consumer confidence. So for the first time, we start seeing in the US some very strong indicators. You know, if we summarize what we've seen to date about the US economy up until the end of last year, there was some slowdown in economic growth. There was some slowdown in PMI. The Baltic Dry Index was definitely down. But when you start looking at confidence, you can see that business confidence was down and consumer confidence was down, which means that there's less spending here and there's less investment. This little tail that you see at the end of the diagram here, in my opinion, that is the reconciliation and of the trade war and sort of between the US and China, and the easing of the trade war between those two countries. Of course, that's gone now, but you know, so that is probably what was driving this business confidence here. Apologies, Mike, I have a gremlin somewhere in my animations. So now we come to Europe. As I listen carefully, I can hear people in the audience weeping. With all due, you paid your money. Come to the party. Okay, so I mean, in Europe, business confidence is below zero, and just look at the trend. Consumer confidence. People in Europe, you are a depressed lot, aren't you? Come to Cape Town. We have lions, and they, you know, look at consumer confidence. And I mean, take note, I didn't even put zero into this diagram, but zero is probably over there somewhere. And then we do China. With China, now this is again, as we saw with the US, you start looking at business confidence in China, and actually it is in the negative territory. Consumer confidence, the only conclusion I can draw here is the Chinese are very, very happy consumers, or up until the end of last year, very happy consumers. And then Russia. There's your zero in Russia. There's your zero on consumer confidence in Russia. I didn't bother putting it in, but we're sitting at a -5. Do I need to say anything? This one is surprisingly high. This one is surprisingly low, because all of the Dutch people that I ever meet are really happy, cheerful people. So I don't quite know what's going on here, ladies and gentlemen, who are in the Netherlands listening to this. And then I had to put this one in. Okay, I know it's completely irrelevant to the conversation that we're having, but please, you know, if you're in the Netherlands, if you're in Europe and you think things are bad, no, they're nothing like bad. This is bad. And this is bad. And this is before Corona. Okay? But that's just my own personal problem. Now we turn our attention to debt. Okay? And I want to start off with household debt. So when we measure debt, there's many different kinds of debt. There's what is called bank loans to the private sector. There is corporate loans from the banks. There's government debt, but this particular one I want to look at is household debt as a percentage of GDP. Because if things go wrong, the extent of your debt determines your room for maneuverability as an individual. And in all cases, I think that there's a lot of merit in starting in 2008. Because 2008, people had run up massive debt. So, and you can see how the debt builds up, obviously financial crisis. You can see how the debt builds up in financial crisis. And in the case of the UK, you can see how the debt has come down marginally, but is nothing like the situation it was, 5, 6, 8 years before the crisis. Therefore, conclusion we draw, in the UK, people do not have the room to maneuver like they did before the financial crisis. The US is a different story. So here we have a much more room for people to maneuver in terms of the debt here today is probably the debt after the dot-com bubble. So I think there's a lot of room to maneuver, and that must give us comfort, because the American consumer is often the group of people who pull the world out of recession. Okay, I apologize. I've got a million questions that I haven't, and with apologies, I haven't been looking at the question and answer. Okay, so there's a question here. What does neutrality mark mean? The neutrality, apologies, the anonymous attendee. The neutrality means that you are you're neither negative nor positive, meaning that if you are above the mark, you are positive, consumer confidence is high, below the mark, you are negative. Rebecca, I'm not sure what your question means. Oh, do you mean PMI for professional services? I'm going to leave that, okay? With apologies. Here's a really bad joke. Please read Art's joke. It's the last comment in the question and answer box. Art, my understanding, it actually is the coffee house, but we won't go there. Okay, so now I flagged Italy earlier on. Look at the debt in Italy, and don't worry about the value. That's not important. It's because it's a perception issue. You'll see the debt from 2000 builds up from like negligible amounts up to about 6% of GDP around about here. After the financial crisis, it continues to increase, and there's been hardly any change in that debt post-financial crisis. This is a big deal. Italy is the third largest economy in Europe. The Italian banks are the third largest banks in Europe. We'll come back to this. Jens, the answer is yes. I'm sorry. I apologize. I'm looking at the question, Jens. Okay, from Maria. Maria, yes, the debt in Italy is lower than the US. I agree, but it's not when one looks at debt, it's important to understand it's not where the debt sits, the value, it's the trend, because these are issues of perception. And in many cases, the way the debt is valued, or the leverage of the debt, the value of the asset. So Maria, I think I pronounced it. So Maria, what can often happen is that in the US, housing is worth more than it would be in Italy, for example, which means that you can hold more debt against your assets, but they're still houses. So it's not the value, it's the trend that's important here. Okay, Pericles, I'm going to, if you don't mind, that's a really big question. I'm going to come back to that. Andrea, household debt it's debt to banks. No, it's more. It's debt to banks. It's debt to consumer and retail outlets and things of that nature. So I'm getting a lot of questions. Okay, ladies and gentlemen, can we park with the questions for a bit? Just park with the questions. Okay, sorry, park with the questions. I'm not going to look at them for a bit. I'm going to focus on what I'm trying to say, because I need to wrap this within 20 minutes. Then we have a full 30 minutes that you can ask all these questions. Yeah. Just, okay. Notwithstanding what I said about the number, right? But do look at the number in the next one. This obviously the Netherlands. And again, in the Netherlands, look at the trend, so there's the financial crisis. Post-financial crisis, Dutch debt went up at a household level and has come down, but the debt in the Netherlands is no different, well, a little bit different, a little bit lower than it was with the financial crisis. There's a room to maneuver issue problem here. And then Anonymous, I'm going to talk about Eurobonds in a moment. Absolutely. That's where we're getting to. A nice question. France, it's just extraordinary. The French are obviously very happy people. They live in debt. All right, I'm pushing now to get to being at a point where we can have a conversation. Bank solvency. We've seen in every single crisis that we looked at earlier on this morning that it's banks that go insolvent that are really problematic. When we measure bank solvency, there's any sorts of different measures, but the most common one is to look at non-performing loans, which is basically impaired loans. If I can use a very simple term, bad debt. It's not bad debt, okay, but it's good enough for the purposes this morning. So what this shows, it shows non-performing loans as a percentage of all bank assets. And you'll notice that Greece is a world leader in non-performing loans, where nearly 42% of all of the bank assets are bad debts. So what does that tell you about the Greek banks? Draw your own conclusion. They are bankrupt. Cyprus again, but notice Portugal, nearly 10%. But the big one, the one that I keep flagging, is Italy, where non-performing loans are over 8% of all assets. Now, there's no yardstick as to what is a good measure of NPLs to bank assets. My personal number that I work with is 5%. So if we sit above the 5% here from Latvia up, and that is Ireland, Bulgaria, I would say that these are banking sectors which have problems and give cause for concern. Okay, so I think with the 400 people in the room, at least 100 are listening when I say, please don't put any more questions in the chat box, but the other 300 clearly are deaf. So Christina, I'm going to get there, okay, but work with me here. I'm not looking at your questions. For the other 100, thank you. Italy is a problem. And then the other one, of course, but it's not, I don't have concern, I'm merely flagging it for a sense of perspective, is France down here. That is a problem, as is Portugal. Portugal, Italy, Europe cannot save the Italian banks. The only institution that could save the Italian banks is the ECB. And historical performance over the last 10 years suggests, please note how I'm carefully choosing my words, suggests that the ECB would probably not want to become involved in saving the Italian banks. But it might. See, it depends very much on who controls the ECB and what they think about Italy. So now the next thing that we want to look at is not just what is what are the NPLs, but what has been the trend in the NPLs. Sanjay, yes, the data is from 2018. It's the latest data we've got. So what this is showing you, this is just a quick selection of countries in terms of the trend in from Anonymous. I do not know about Estonia. Is it in the list? No, at the bottom, at the very bottom. Estonia is at the very bottom, huh? There. in terms of the trend, you'll notice that Italy was significantly high 2014, even 2016. So it's only very recently that we've seen these non-performing loans come down. So one mustn't view this thing here as, okay, the Italian banks are cool, there's no real problem, 8% is doable. It's not. It's that, in fact, the Italian banks were sitting close to pushing 20% of NPLs just recently. And this drop is a recent trend. The other one, now I've got Spain, whoever was asking for Anita, there's your Spain, there's Spain here. I don't know why I have Iceland. And then in the UK here. Can you imagine what, and you don't have to because you've all seen the news, what Italy looked like in January and February? All the shops were closed. All the restaurants were closed. All the fashion houses were closed. Gucci was closed. All the motor manufacturers were closed. Tourists are not going, and tourists will not go to Italy. So you've got this massive household debt that we saw a moment ago, which has to increase dramatically on the one hand, and where people are going to default on their debt. Not obviously because they want to, but because they simply have no choice. Businesses are going to go bankrupt. What is going to happen to this trend? Well, we don't have the data. This is the latest data that there is, the 2018 data. But this is going to go up. It has to. There's no way out of this. So now, let's look at something more cheerful. Let's look at equity markets, stock markets, share markets. And this is at the end of February. And if I can just summarize where this conversation is. The conversation is that in terms of, apologies, can I summarize where the conversation is about the state of the world before the coronavirus? We have, in all but 2 countries in the world, the economies are either in recession or going into recession. The US was not looking good, but it wasn't in recession. China was looking okay. But then if you look at all of the indices, the Baltic Dry, the PMI, confidence, all of those indices, maybe not even, no, all of them said that the world was heading into recession. So it was very clear the direction of the world economy. And you know, once a place like Europe goes into recession, that has the effect of bringing down other countries in the world. So Africa is dependent upon people coming from Europe as tourists. We are dependent upon selling our wine to you and things of that nature. So if Europe goes into recession, we really feel that impact. So equity markets reflect people's expectations on economic outlook. They reflect people's view whether companies are going to make a profit or a loss. They reflect the view that there's going to be increases in capital value because economies are going to grow, or there's going to be falling capital values because economies are going to slow down. They reflect that there's going to be increased dividends, dividend streams because there's more profit, or there's going to be decreased dividend streams because there's going to be less profit. That's what stock markets do, because they reflect people's view of the future, and people's view of the future is driven by what's happening with the economy today and our outlook and all the leading indicators, et cetera, et cetera, et cetera. So let's look at that. Isn't that funny, eh? Try Japan. In the last quarter of last year, the Japanese economy shrank by over 6%. 6%. Look at the Nikkei. What's going on? Look at Europe. Everything in Europe was slowing down. Look at the German economy. Germany was going into recession. The Dutch economy. Sorry, I've got some funny thing happening here. How do you spell Brexit? Very, very badly in this case, because it's simply not reflected in the stock market. The French economy. Do I have a bubble? No, there, French economy. And the only one that makes any sense is the Chinese economy. Look at Russia. So, okay, I'm seeing a lot of questions. These are, Martin, just bear with me while we get back to that sort of very precise questions. I'm not sure what you're referring to. So, okay, let's just draw a very, very simple conclusion. Stock markets should reflect the outlook for economies. The outlook for economies, in my opinion, and I hope the evidence that I presented to you was negative. The stock markets are in a parallel universe. The stock markets are simply not reflecting the reality of the world. Let's just get the best one. That one. I do hope, I mean, everybody in this room is intelligent. We're intelligent people in this room, except for the presenter. There's a bubble. There's absolutely a bubble. If you have share markets which are moving so radically different to what's happening in the economy, it's a bubble. As simple as that. What has fueled the bubble? The monetary and fiscal stimulation from the financial crisis. So where the world sat at the end of last year, as the coronavirus was just making its situation, it's making itself felt, was in a world that was slowing down with a massive stock market bubble, and I suspect housing bubble. So let's move on. I'm looking at my clock, and so let's look at housing. I know this is a very messy diagram with apologies, but it's about the best that I can find. The blue line in every case is 2008. Just to get a sense of what things looked like in the financial crisis, because we all know that there was a major housing bubble. So if we take the US, and this is an index, so if we take the US, for example, there's your 2007, 2008, and that's where the US sits at the moment. So US housing is sitting at a price which is the same as it was in 2008. There was a massive bubble in 2008. US housing prices are today no different to what they were in 2008. If you look at the UK, the blue line. There's the UK in 2008. There's the UK as of the end of last year. There's no difference. Okay. And then if you look at Canada, I'm not sure if you know where Canada is. It's full of trees. It's some funny place in America full of trees. You'll see, with apologies, he was Canadian. You'll notice, obviously, in Canada, the housing prices way, way higher than they were in that period. If we take the net, they start off with Italy, because now we've got the UK. Okay, if we take Italy, there is the financial crisis, and there's Italy. A little bit lower, but not a lot lower. And then for everyone in the room who's Dutch, and I know, and this is a really unfortunate one, the Dutch housing market never ever really recovered very strongly from the financial crisis. So in the case of the Netherlands, we don't have a housing bubble, but we don't have high housing prices. Then the last one I want to show you, this is a bad diagram, is China. Sorry, just have a look at Britain. Okay, so Britain is the blue line in here. But there's the crisis, and Britain sitting up above the crisis. But look at China. So we're looking at an index of 100, and this is the fourth quarter. China sitting index of 200. Is it a bubble? I don't know. Okay, with apologies, I'm moving fairly quickly now, just to get to the point where we can finish this talk and have a conversation. Okay, so in terms of, so what happens after Corona? Well, you know, what's the forecast? Well, it depends on how long it takes and the trading partners. And what I want to do, which is what I said I would not do, but I think we need to get some sense of this. So what's the impact on the Dutch economy? It's a fool's game to make this forecast, as I said before, because you will be wrong. So what I would prefer to do, and what I got the boffins of my company to do, because they're clever, was not to work out the likely impact on the Dutch economy, but to work out the minimum impact on the Dutch economy. What's the least damage that Corona could do? Not what is the damage going to be. I then want to look at various wealth bubbles. We discuss banks, and then I go for closure. But yes, I'm not sure, but with apologies now, I'm moving fairly quickly, so I'm not looking at the question answers, which is now about 1 million. And then I want to get to policy options. So let's just quickly, I don't want to bog down in this one, and I'm very conscious of the time at this stage. The way that the calculation was made of the impact on the Dutch economy was a fairly simple exercise. This is not difficult. Working out the impact of Corona is not difficult. Leaving aside the humanitarian crisis, the mortality and morbidity, that just leave it aside. By what extent will different sectors slow down? So that's where we started. So we said, okay, so over a quarter, meaning the last 3 months, by how much would each sector contract? And it was not scientific and detailed analysis. But our feeling was agriculture would hardly have any effect at all. And so now I say this with all due horror. These are the tulips. That was a tragedy. So those are the tulips, but cows are still there, and butter is still there, and cheese is still there. There will be some drop in construction, but it's relatively small, you know, and it's only for 1 quarter. It's only for 6 weeks. So it's only for 1 quarter that it contracts. Manufacturing, we think, would contract by about 30%. Again, this quarter. Mining is insignificant in the Netherlands, largely because public administration, hardly any impact. These are nurses, teachers, people of that nature. These are the 2 big ones, services and transport. Services is tourism, hotels, retail trade, restaurants, things of that nature. And transport, obviously, is general transport, people driving around, as well as public transport, as well as Schiphol Airport, as well as all of the shipping vessels that go up and down the Grote Maas in Rotterdam, etc., etc. So we saw those as big impacts. I don't want to debate the decimal pointing because it's not important here. It's just, so that was a kind of a line in the sand that we drew. And then we said, after the first 6 weeks, the economy would recover and recover very rapidly, so that by the end of the year, the economy will have been back to where it started from. So really conservative estimates. Let's not worry about that. So this is the likely impact. So that was the first quarter. That is actually what it was in the Netherlands. This was our projected second quarter. And then the economy recovers, and you can see we've actually got the recovery by the end of the year more than the first quarter. So it's a really conservative assumption. If that happens, if it happens, and I don't know whether it will happen, that's not the point. The Dutch economy will contract by 9%. Which is more than the financial crisis. It's way more than the dot-com bubble. It's more than the Japanese lost decade. And it kind of gets close to the Great Depression. And I think that number is drawn on very conservative assumptions. Now, we can argue about it, and I know in the question time, everyone's going to start throwing things at me. It doesn't matter. You know, we can throw it around a bit, but that is a big number. So if that big number is 7%, it's still a big number. That's the only point. If we want to make the number bigger, let's have a 2-quarter fall. Okay, so we have the first quarter lockdown. We have the first quarter lockdown, but then the pandemic goes on, and you know, many of you in this room are Dutch. So what do? You do exactly as you've been doing in the last while. You stay at home. You don't go to the restaurants. Right? You don't go traveling. Carola, I'm not sure how good news can make you very chilly, but yeah, 2021. So no, we're not even doing 2021. Eh? 2021 is good. You'll have like 40% growth rate or some such number. I'm just doing 2020, so let's do it. So then, if you look what's going to happen here, the drop is not so bad. So now I beg your pardon. The drop is not so bad, but it continues for longer. But by the end of the year, the economy is back to where it started from. Okay, it's not a big deal. So let's move on. So now these are equity markets. Sorry, change of subject. These are equity markets at the end of March. Here is the financial crisis meltdown. This is the Dow Jones. There is the meltdown at the end of March. That is the bursting of the bubble. I said there was a bubble. I remain in that situation. There was a bubble. Look at the relative drop here. It's the same as happened in the financial market. Look at the FTSE, the London share market. If you can't see it, it's over there. It's the same, relatively speaking, contraction. Amsterdam, well, the Dutch are much more sensible, so that's the financial crisis. But look at that contraction. It's not as big as the financial crisis. This is, if you want, just get some emerging markets. Okay, there's Australia. And if you want another one, here's South Africa. And the point I'm trying to make here is that it's not just Europe that's being affected. It is a worldwide phenomenon, just as all bubbles are a worldwide phenomenon. I know I'm moving rapidly now, but my experience at these talks is that the talk is scheduled to finish at 11 o'clock. If I go 3 minutes past 11, there's nobody left in the room. So everybody leaves at 11 o'clock. In fact, given the depressing nature of this talk, you're probably all leaving as I speak. Okay, so what can governments do? Well, they can go for fiscal stimulation, but there's major debt constraints. They can reduce interest rates. They can go for quantitative easing. So let's see what the options look like. What this diagram is showing you, it's showing you government debt as a percentage of GDP across a selection of countries, many of which you live in. And the international benchmark is 60%. So if you just cast your eye across the diagram, which countries are below the 60% mark? Well, there's Sweden, but that's just full of snow, so you won't worry about that. There's the Netherlands, which is almost there. There's Germany. It's not a pretty picture. And then if you look, this sort of reddish line is 2012, the green line is 2019. Look at the trend in government debt since 2012. It's got bigger. This is US. It's got bigger. Spain, it's got bigger. Japan's a world leader. Italy's got bigger. Greece has got bigger. France. So the conclusion that I draw from this is that government debt is too high. Government debt is beyond acceptable limits. And if government is going to fund the corona stimulus package, which is needed, let's not get this one wrong. You've got to do it. It can't borrow the money, because nobody in their right mind would lend money to governments except the Dutch government and the German government and the Swedish government. So if governments are going to borrow money, the only way they can borrow the money is to print it. And in the case of Europe, that's from the ECB. So now let's look at interest rates. Okay, so this is US interest rates. They're sitting at close to 0.5% as makes no difference. But that's not what's important. What's important is what their real interest rates look like. So there's your nominal interest rate. And there's the nominal rate, which is now read off over here. And the dotted line is the inflation rate. In a nutshell, when inflation, as you know, when inflation is above nominal interest rates, real interest rates are negative. So real interest rates have been negative apart from that little period here, as far back as one wants to look in the US. Again, you know, but I'll say it for those who don't know. What do negative real interest rates mean? It means that people are paid to borrow. So if we want to stimulate the economy through corona, you have to pay people even more to borrow because they currently are being paid to borrow. So we have to cut interest rates to below zero, which is kind of difficult. Here's euro interest rates. Put inflation across it. In Europe, just if I take that period there, real rates are negative. You are being paid to borrow. In the UK, okay, there's a proportion issue here. Interest rates in the UK, please call them zero for want of a better word, which is now on the side here. Inflation is well above that. So it's just the way that these two things sit on top of each other. Inflation is well above nominal interest rates. I'm going to skip that one. And then we come to quantitative easing, which is the simple printing of money to pay for government debt. So we go back a few slides. How's government going to stimulate? They're going to print money to buy the debt. That's called quantitative easing. And you read it on the central bank balance sheet, Fed balance sheet. There's the first QE, there's the second QE, there's the third QE, and the total amount of QE is $3.5 trillion, starting from 1 trillion. So this is a 350% increase in money base. In Europe, okay, the ECB always takes a while to get its act together, kicks the can down the road, and talks many things. 3.5 trillion euros from a base of 1 trillion euros. So we're talking about massive increases in money supply. Massive, massive, massive. So what can governments do? Well, they can go for fiscal stimulation. Currently in the States, we're talking about 2.4 trillion fiscal stimulation funded through QE. 2.4 funded through QE. Where did this money go to? It went to create a bubble. Where's the 2.4 going to go to? And then in Europe, at the moment, we have a 500 billion, which is a ½ trillion fiscal stimulus package. Now, somebody asked the question. Okay, now this one's really important. Okay, so there is currently nothing quite clear about how it's going to get paid for. Okay, so we start seeing the ESM as a means of paying for it, which basically means that governments, Italy, has got to borrow from the ESM. I don't know if you've seen the backlash in Italy against the proposals from the Northern League, and there's massive resistance against that. We could go for Euro bonds, which is where governments collectively sell bonds into the market. So Italy can sell Euro bonds into the market. There has been just a little bit of resistance from Germany and the Netherlands. Basically, they said nay or nine, whatever accent you want to use. But I heard nay very loud all over the place. So at the end of the day, the ECB probably will have to come to the party, and it will be QE. And it's going to be much more than that. So now, what's going to happen to the money? And I don't mean, with apologies, obviously I don't mean what's going to happen with the money. There's going to be the purchase of respirators, there's going to be medication, there's going to be face masks and sanitizers. Those things are clearly non-negotiable. So that's, in no way am I saying that shouldn't happen. It's afterwards. It's when the makers of the sanitizer, the makers of the face mask, when they get the money, where does it go to? Now, somebody asked the question earlier on. What about inflation? I forget who asked the question. Kun, I think you were asking the question maybe. So can I go to inflation? Well, just think about that other 7 trillion, $3.5 trillion and 3.5 trillion euros. Did it cause inflation? Well, there's your answer. It didn't cause inflation. Okay, simple, didn't. Why? We have another seminar one of these days. We can have a long discussion about that. It can go to emerging markets, but it's only going to go there if there's a carry trade, which means that interest rates between the rich world and the emerging markets have got to attract the money. So what you're looking at here is that's precisely what you're looking at. The blue line are interest rates in the States, read off on here. The dotted line interest rates in Brazil, read off on here. And you can see there's a major incentive to move money from the States into Brazil until you get the situation where Brazilian interest rates begin to decline, or until you have the situation where in Brazil you have a president who thinks that if you're an athlete, you'll never catch corona ever, which is an interesting way of doing it, and then you take your money out. Or it can go to equity. I do hope you understand where I'm coming from this morning, which will create a bubble. And even if the bubble does not burst, what it's going to do, it's going to create massively low yields on equity, on bonds, and if you're in that kind of mindset of that age, on your pension. Just look at the yields. In the year 2000, yields were kind of 6%. Today, it was yesterday, in fact, they're 0.6. Which means that if you want to retire in the next short while and with those kind of yields, you need 10 times more capital than you did 15 years ago. Okay, so now let's do them. I think this is the last one. So now let's look at equity markets in early May, which is basically yesterday. Yeah? There's the bursting of the bubble. All the stimulus packages are announced around about here. Where's the money gone? Or where is the perception about where the money is going to go? That's the Dow Jones. This is the NASDAQ. Please take note of the dates. This is yesterday, the NASDAQ. This is Amex. Even Australia is not exempt. And the one that, you know, that it like just jumps out and shouts at me is this African share market. Because the South African economy is in a terrible state, not just from Corona, but truly in a terrible state. So I kind of think that I've deliberately done this as a long walk around a garden that started off. So what is it that causes these big shocks? And there's these big financial crises, and obviously there's like wealth effects and all the rest of it. There can be natural events that cause it. There can be droughts that cause it. But in that whole mix, and obviously in this case, it's a natural event. In that whole mix, there are wealth bubbles, equity bubbles, housing bubbles, bank failures, potential for bank failures, and then policy stimulation. And the policy stimulation creates bubbles. I beg your pardon. The policy stimulation historically has created bubbles, which then create the next financial crisis, which then we have more policy stimulation, which creates the next financial crisis, another bubble, and that is where we are. So let's deal with the very last, this is the very last slide, I think, okay? So where are the political fault lines? Now, where's the major thing politically? Well, I said it a moment ago in answer to a question. We've got now, no sitting American president has ever been re-elected in a recession. So how do you stimulate or make yourself look good or do whatever you have to do to get out of the recession? You reduce the lockdown as soon as possible to get the economy growing again. Okay, there's going to be a humanitarian crisis, but reduce the lockdown so that by November, the economy is growing again. And if that doesn't work, or to go along with that, let's start a huge trade war with China. That is my reading of what's happening in the States. The second, you've heard me saying it all along the way here, is the potential of Italy and the Eurozone. If Italy is forced to leave the Eurozone, so the mechanisms by which Italy might be forced to leave it. Italy's forced to borrow from the ESM. And the Northern League, and it's already happening, major resistance, major political problems. And Giuseppe Conte he has some political support, but not a lot of political support. So we could see a new parliament in Italy. Alternatively, Italy goes through the Eurobond market. That's a way better solution. But there is basically, the Dutch finance minister, I think, I forget precisely who it was, is absolutely adamant that this is not going to happen. Or the Italian banks fail. All of those things, any one of those things could mean, definitely not going to. Italy is not going to leave the Eurozone. Never, ever, ever. But it could. And any one of those three things could result in Italy leaving the Eurozone. The same holds true for Spain, but just to a lesser extent. I think I'm just going to just go. Okay, so this is just very quickly Italy and Spain. You want to get a quick sense of it? These are your corona cases in both countries. The blue is Italy. This reddish color is Spain. You can see Italy's worse. This is your government debt in both countries. And you know from the previous one, the 60% is the benchmark. So there's 60% in Spain. And there's 60% in Italy. Yeah, somewhere down over here. Italy is like just in the stratosphere. Here's your government deficit where 3% is the mark. And I'm not going to worry about that one. And then here's your household debt, which you've seen in Italy. Here's Spain. It's a lot better. And I think that's it. Wow. Okay. So I hope I've depressed you significantly that you have no questions left. Okay. So now the way we deal with questions is you need to put your hand up, and Tom will administer the process. So somewhere on the participants box, you will have a or if you don't want to, you're more than welcome to type in.
Hello, Barry.
Yes, hi.
Yeah. So my question is that this crisis is originating outside the financial crisis. Like it's not from the financial market that this crisis is originating. So, and how healthy are the financial market that pull us out of this crisis?
The financial institutions are a lot healthier than they were in 2008. There's no question about it. That you've had Basel II and Basel III, and all of those things have made institutions way, way stronger. So, frankly, I don't have concern about the financial institutions, except for Italy, as you probably heard. And of course, Greece and Cyprus, but those are, with respect to what is Greek or Cypriotic, those are small. But the Italian one is problematic. So I don't see the problem. However, I don't see a problem. However, it's not that the financial institutions will pull us out of the crisis. It's that central banks, through financial institutions, have got to pull us out of the crisis. And the only way they can do that is to have further negative real interest rates, which is difficult when nominal rates are already at zero, or they have to go for quantitative easing. And the mechanism by which quantitative easing has been happening recently is through the purchase of government bonds. So Kartik, it's not so much the banks that are going to pull us out, it's the central banks through the banks that have got to pull us out.
Okay.
And you've seen what my feeling about the potential consequences of that is likely to be. From Marit, can we use bubbles that cancel capitalism and go? No, we can't, Marit. If you really believe what you're saying there, then I think you and I should meet tomorrow morning with pistols at dawn. Federica, you got a question? I see a hand up there. Okay, so we had a million, Federica, yeah?
Yeah, I had a question. I read on CNN that economists believe that Europe might get out of the recession faster because of how they've handled job security. by linking help to businesses so that they don't put their people on the street or lay them off, whereas the US, everybody's been laid off. Do you believe that that is true, or will that not have an impact? The way Europe is handling it.
Yeah, I understand. I think it will have a marginal impact, but I don't know that it's going to have a significant impact. Short term, I'll come back to the long term in a moment. The short term impact, irrespective of where you are, has been a significant drop initially in demand because nobody was spending or going out or anything. And then because people weren't actually working, a significant drop in supply. So no matter how you cut that cake, there is a fall in income, irrespective of how you deal with it. Irrespective, there's a fall in income. Then the question is, how do you deal with it? And irrespective of how you deal with it, it has to be government that is funding the smoothing of the crisis. So in the case of the US, the smoothing of the crisis is a massive, is that $2.5 trillion bailout package. A lot of it's going to go to people. So there's talk of actually getting money directly into people through social security payments. Whereas in Europe, it is a matter of subsidizing businesses to keep the jobs. So the mechanism is different, but the objective is the same. So now it becomes a matter of what's the value of Federica, what you hear, the way I'm trying to say this is that I don't believe the net result is much different. Post the crisis, now here's the interesting one. So post the crisis, it's very likely that the European businesses will pick up steam because they've still got their employees, there's all the processes and everything are still in place. And they'll probably get up and running more rapidly. However, here's a different throw on the CNN one, and I've seen that discussion. This could make the US far more flexible and entrepreneurial. Because in Europe, you might well have, let's go back to business as usual. In the States, you could, and I think it's going to happen, you could end up in a situation, well, let's do things differently. I don't have a job. Let me do things differently rather than, I am a chef in a restaurant. Let's go back to doing that. So I think, Federica, I think that's a lot. That kind of thing needs a couple of days work to really think it through. But that's off the top of my head answer.
Hi, Barry. Thanks for the excellent lecture. It's always great to hear from you. I had two-point question. The first is, we've talked about stimulus and as being vital to getting out of the crisis. What can governments do or central banks do differently to administer stimulus in a way that doesn't create the sort of addiction or the sort of, spending the stimulus into assets that may not hold value? And the second part of the question, Barry, because you support, I guess, a company, a part of a company, you own a company that gives investor advice. Given the fact that yields are going to get low and there's a bubble, where are you advising your clients to park investments?
Okay, so for the second part of the question, I will send you an invoice, right? Okay, look, I think that those two questions are the same question. It really is the same question. What can central banks do that's different? The answer is nothing. There's nothing they can do. You see, because where this whole thing has come from, it's come from this ongoing stimulus, crisis after crisis after crisis. Now, what we really need to have happen, no, let me rephrase that. The best position to have been in would have been in a situation where governments did not have debt or had very, very low levels of debt. The current levels of debt we're seeing in Europe are not dissimilar to the kind of debt that you see that governments have after a major war. So if one looks at the Second World War, you'll find that debt post-Second World War, okay, it was a bit higher, but it wasn't significantly higher than what we see now. So we're in a situation where governments, post the dot-com bubble, there was a significant opportunity for governments to run down their debt, to be in a position where they can, where they could have fought this stimulus package from fundamentals rather than having to print money. But because we're now in a situation where debt is simply too high, nobody will hold that debt in their right minds. So if if one looks in Japan, the biggest holder of government debt in Japan is the Bank of Japan. So what central banks have to do is what they have done, or they have to print money. Simple, there's no option. So my advice, buy equity. So even though you know it's a bubble, you have to buy equity. Vishal, the invoice.
Yeah, thanks, Barry.
This is from Scott. Scott, what's the government betting? Because I think if I may, Hadi, ask me a second, please. Just you asked a question about gold. Gold was about $1,700 an ounce this morning. It's just shout that we are back in bubble territory. It's screaming out. It's screaming out about the loss of faith in money. And Vihal, you'll come back to your one. Buy gold, young man. Buy gold. It's the other thing to do here. Hadi, I think you look like you're on the screen. I'm not sure if you've got a question. No, okay. I see Thomas up on the screen. We're probably out of time. It's 11 o'clock on the dot. We're losing people. That's my experience. Artemis, yes. Okay.
Yeah. Well, my question is that so far you've been talking about the same old as we've been, handling crisis for, let's say, the last 90 years. Perhaps it's time with this crisis to think outside the box. And so going with, government bonds and all the other things, it begs the question whether we are not setting ourselves up for the next bubble and the next crisis in 10, 15 years' time. I know that there are some countries in the European Union who've been advocating universal basic income for all over Europe. I know that in the Netherlands, the Central Planning Bureau has been doing the calculations, and apparently €600 plus 600 per person, 18 and over, and 600 per household extra if you're alone, or if you're three, then you get €2,400. Apparently, it's doable from all the money that the Netherlands is already paying in social securities. It would be the same money. So that's just this country. I have no idea how that would work in Germany or Spain or Italy. But if we would do that, we would boost the confidence of consumers, and that is a way of getting back on our feet, isn't it?
You can't end the question with "isn't it?" because then I have to agree with you. Right? I think the question is a two-part question. Okay, so the first one is same old, same old. For me, as the answer to Vikal, for me there is no alternative to get out of where we are. You see, let's do it differently. Right now, as we speak, the only option that there's only one option government has got. It's whether to stimulate or not stimulate, and it's not a stimulation in the true sense of the word. It is help people. So how do you help people? And you can help people either by putting money into Social Security as they've got in the States, or Artemis, or we go for some other form of Social Security, okay, be it as it may, or we go for the Calvus thing in the Europe, which is to subsidize firms. However you do that, whatever you're doing there, you are giving money to people, okay, in some form or other. The question is, where do you get the money from to do that? So if in the and in the current situation, what you've got is you've got people who are not working. You've got businesses who have closed down. So actual production has declined. So now it's not so much a matter of money as income. So people's incomes have declined. So now, if we want to increase Social Security, or let me just go with an increase rather than just a redistribution. If you want to increase Social Security, you can only do it either by taxing people. So I'm going to tax you to give me money. So you've got less, I've got more, which is cool because you're rich and I'm in South Africa, so I'm poor.
Taxing companies is not being discussed. I feel like Rutger Bregman. Taxes, taxes, taxes. That's what we should talk about.
No, we can do that, but the point is that if you're taxing a company, you know, you're still taxing people, because not that companies are owned in a vacuum. So if you tax me in my personal capacity, or you tax my company, it just means in either way I have less, because companies are people. So, you know, so right now, you probably don't have the option of increasing taxes, because all you're doing is you're taking money away from some people or some companies and you're giving it to others. So you therefore have to create the money, and or you have to borrow the money. Okay, this one, like, so you've got to borrow the money. So in the case of the Netherlands, if the Dutch government wants to borrow the money, just keep it simple, it would borrow the money from Dutch people. But that means that some Dutch people who've loaned the money to government don't have the money to spend, but voluntarily, and you've given it to people who desperately need the money. But the net overall effect is the same. So it's not a stimulus package. It's just a redistribution package. So then the only way you can stimulate is for governments either to borrow elsewhere, and nobody will lend the money, or to print the money. You know, so we come back in the same thing. So the issue of a social security net, that's a different issue. That's a redistributional issue, and is it more efficient? But if you don't mind, I'm not going to go there in that conversation right now. We can. It's almost like hearing all this question. We need another session at some point to have a broader discussion about these things. Artemis, I hope I've managed to answer your question as best I can in the time. Okay, I'm looking, if there's no more questions, yeah, I see people are leaving. So then if there's no more questions, then what I can share, I'm not sure if Rachel, anybody wants to go for closure, but Rachel, if in the, people are leaving. Okay, so ladies, gentlemen, thank you very much. I can only wish you all the best and be safe out there. And if you have been very, very depressed by this conversation, do go to a coffee house and feel good.
Yes, thank you. Thank you so much to everybody for joining and for such a passionate discussion. Clearly this, as Barry said, is something that we should perhaps revisit in, I said 6 months originally, but now I'm thinking a couple weeks. Things are changing so quickly. So yes, thank you to all the alumni who have joined us. I am very sorry that we could not get to everyone's questions, but this will be recorded and you will receive a link to the recording as well as a brief survey by email later today. Please fill out the survey. This is our first faculty talk. We hope to have more, but your feedback is very valuable as we build these. So thank you. And Barry, thank you again so much for sharing your It was a bit depressing, but you know, what better way to start a Wednesday than some real talk. So thank you all so much. Have a lovely rest of your day, and the alumni office will be in touch soon. So thanks so much.
Thank you, everybody. Bye-bye. Have a nice afternoon.